Hi, everyone, and welcome to Leaders in Lending. This is Lynn Sautter Beal. I'm happy to be joining you here today from CBA Live, and I have Dave Pommerehn and Billy Rielly joining me today. So thanks for being here, gentlemen. I would appreciate it if both of you could just kind of introduce yourselves and what you do at CBA.
Sure. Yeah. Hi, everyone. David Pommerehn. I'm General Counsel and Head of Regulatory Affairs at CBA. So I deal a lot with the regulators in DC, and of course with all the ongoing litigation around some of the former CFPB's rulemakings.
And I'm Billy Rielly, Head of Public Affairs. So we handle messaging for the organization on behalf of our membership, work very closely with the regulatory and legislative teams in terms of policy communications, and also support broader corporate comms and executive comms, including helping to set up this conference and some of our other events like our executive banking school.
Well, great. Thank you. Again, appreciate you taking the time to join us today. So I'd really just ask each of you to kind of give a brief overview. Obviously, there's a lot of things changing in the market right now with the current regulatory and political environment, but just kind of a lay of the land. Like, where do you see things stand right now with the current environment out there and how it's really impacting CBA members?
Sure. Yeah. I mean, it's a very unique environment, and it's changing by the minute. So any predictions we could give you probably are going to be wrong because they're going to change very rapidly. Right now, I mean, we're in this kind of limbo, right, where the new administration has come in. A lot of executive orders, a lot of internal kind of rearranging of some of the agencies. And we're not quite sure where it's going to end up at this point. So we're working very diligently with the administration. We have nominations for new director. We have nominations for a new comptroller that are working their way through the Senate now. And so hopefully once we get people in place on a permanent basis, there will be some I think stability, so that we can go and start talking to the individual agencies. We need the agencies to function. We need to know who we're dealing with, right? And the banks need to have certainty within the markets and the rules that they have to abide by and compliance issues. So there's a lot of question marks right now. There's a lot on people's minds, and so we're working through that, and hopefully we'll again get to a better place in the near future.
Yeah, just to add on that, I think the uncertainty is a big one, but it poses some, we think, positives, but also some potential headwinds. So obviously bankers know that the last 4 years in the prior administration in terms of some of the financial regulatory rules that came out posed significant challenges for our members and kept us at CBA very busy. Obviously, a lot of that is going away, or we think it is. And so in the sense, in the positive sense, that may be a good thing, but we also have a political system right now with Republicans that may be a little bit more skeptical of large institutions, including large banks in particular, with the rise of populism. So something else to keep an eye on, especially as it relates to Capitol Hill, but some of the proposals out there that maybe our banks won't be as supportive of.
Sure. And I definitely hear you on the uncertainty. You know, we have over 100 lenders of both banks and credit unions on our platform, and my team is actually supporting them through their regulatory exams. And so that is and we deal with all of the regulators too. So certainty certainly helps us do a better job for our clients and helps our clients have a better understanding of what to expect. So, you know, with kind of the status of the CFPB right now, ongoing legislative debates and certainly states getting more active in the regulatory space and potentially even more so if the federal prudential regulators kind of back off. You know, I think how are banks adapting to these uncertainties, and what kind of advice are you giving your members on ways to stay kind of proactive and to at least navigate as smoothly as they can through this uncertainty?
Yeah, I mean, it's as Billy alluded to. I mean, a lot of the rules that they're currently gearing up for are, in limbo right now. They could go away either through actions by Congress, actions by the agencies themselves, or through litigation. Our banks are business as usual right now. I mean, they're still beholden to the consumer protection laws, and they're complying with all of these things, and regardless of whether or not the CFPB is in there supervising them for any of these issues, hopefully we'll get back to, again, a sense of stability on the supervisory side soon. The prudential banking regulators are supervising, holding examinations of those things. But a lot of the prep for things like 1071 small business data collection, this is a huge pull for the industry, and they need to understand where that's going, and what the Bureau might do with it, what's going to be the outcome of the litigation. And so in large part, I think you have to plan for what we know now, and that's where they're going with this right now. But things could change on a dime, and that cost compliance dollars, obviously, which is not ideal. But I mean, banks need to get back to what we're talking about, the certainty around some of the rulemaking, some of the compliance issues that they have right now, in order to better function and quite honestly, better serve the U.S. public. So.
Sure. And I think, we certainly, the clients that we work with are many of them are not CBA members. They're more, regional community banks, and the potential costs of uncertainty, I think is hitting everyone hard, but certainly hitting them hard as well. So I think one thing that does stay in the spotlight, as you mentioned, consumer protection, and how the banks are doing the things that they need to do to protect the consumer, regardless of the rules, and the regulators are still doing their regular exams. But late fees, overdraft fees certainly remain in the spotlight, as well as CRA modernization efforts, and lately some I think proposals to get rid of CDFI as an organization. But kind of with all of the different things happening, what are some of the areas you think that banks and financial institutions should really be paying special attention to, as it relates to some of those, I think, particularly the consumer focus items like late fees, rate caps, overdraft fees?
I mean, these are all important issues. Clearly, this was part of the previous administration's junk fee campaign, quote unquote junk fee campaign. I think it's been painted in a large part as a populist issue, and actually the cost benefit analysis wasn't really completed when they were looking about how these rules actually could impact the U.S. consumer. What should our banks be looking for? I mean, as you know, with late fees and with overdraft fees, there's litigation on both those fronts. The overdraft fee rule is subject to a Congressional Review Act resolution currently in front of Congress. So, how they are navigating, again, it's, I hope we have answers soon. I hope that we get back to a place where we have a durable, credible agency within the CFPB that's going to do cost-benefit analysis rulemaking where there's a market failure. Right now, we're really just kind of combating all of these rules that were more political in nature than really addressing a market failure. Some of our member institutions, for instance, in overdraft, they're the leaders in putting together mitigating ways for consumers to actually avoid overdraft fees with buffer amounts, 24-hour grace periods, things of that nature. Where was the market failure that precipitated this need for this kind of outlandish rule? And so that's what we're dealing with now. I am very hopeful that over the next year or so we can see a lot of this litigation go away, get back to really appropriate rulemaking that's done within the confines of authority and not for political reasons.
And just to add to that, so obviously David mentioned the late fees and overdraft fees driven largely by the prior administration, and you also mentioned rate caps. And we recently saw a proposal introduced in the House as a companion to a previous legislative proposal in the Senate, both of which had bipartisan support, seeking to limit bank and credit card issuers' ability to charge interest rates above 10%. Which is concerning for a lot of different reasons. And so that's something we're keeping our eye on because of the bipartisan nature of it. And one of the many ways that we're trying to push back on that here at CBA, whether in the media or through some of our blogs and op-eds, is trying to show through data and research the impact that that would have on consumers, and especially consumers at the margin and their access to credit, because a lot of times these legislative proposals make for good political headlines, but they have real-world implications on the people we're working to serve.
Yeah, absolutely. And I think you both called it out that, doing a true data-driven cost-benefit analysis, what really will happen if you make changes like that? And the answer is that a lot of lenders simply won't be able to lend to, especially consumers that I think when we originally started our company, were looking to expand access to credit and maybe identify what we saw as those hidden primes or near primes that the banks weren't reaching. And those folks are easy to get kind of put out on the edges of the banking industry again. So what do you as you think about maybe the federal regulators being weakened a little bit or being defunded or having less staff potentially, do you see a potential for individual states to create more kind of a patchwork of regulation that it makes it even harder for the banks to understand?
It's a great point. Yeah, and we need a strong federal regulator to set, the kind of the path here. It's difficult for our member institutions to kind of piecemeal regulation and enforcement through different state actions. We're seeing a little bit of that now. I would imagine that you'll see more ramp up with the AGs, especially in blue states, where if we don't have proper supervision from the bureau or from the prudentials. We're really hopeful that the Bureau will start that process again, and that we'll get back to a good place. There's also the private right of action for a lot of the enumerated statutes within Dodd-Frank. So we are somewhat concerned that you could see an uptick in lawsuits from the plaintiffs' bar. But that wouldn't be anything new. The plaintiffs' bar is going to take advantage when it can take advantage of something. But I do think that we'll probably get more action from the states as we move, into the near future. But again, I don't think that was anything particularly new. Mm-hmm. We saw that ramp up even with the Biden administration.
Sure.
So
sure.
I think that we'll see a little bit more of it now.
Yeah, and that's definitely something, we certainly track a lot with like the legislation in Colorado and different,
DMCA, right?
Yeah,
Mm-hmm.
and DMCA opt-outs. Those are challenging to manage when you're a company that works across the country. So, as you think though about protecting consumers, ensuring competition, do you see any tension between kind of those two things? Like how are your banks bank members staying competitive and with each other when there's certainly a lot of, I think, kind of regulatory uncertainty, and they also have to think about consumer protection.
Right.
I can start with them. And I mean, we always talk about how the banking industry in America is among the most highly regulated, most competitive in the world, right? And so that really does benefit consumers in the sense that because of the regulatory apparatus, they can have confidence that they are being protected, that their money is safe and secure. But also with that many banks and credit unions, and also with the rise of fintech and tech companies that are increasingly offering financial services, consumers have amazing ability to choose financial products and tools that meet their unique needs, right? And so I feel pretty confident, Dave, I think you would agree as well, that this system really does provide so much flexibility and choice and access. And I think nowhere has that been more evident over the last decade than in overdraft. And you've seen so many of our members innovate on that product, offering financial flexibility and next day grace periods. Because banks really want to meet consumers where they're at, number one. But number two, the market is getting more competitive with other fintechs and such that are offering low or no cost overdraft services. And so that competition, I think, is benefiting consumers, and consumers can have that confidence when they meet their needs within the well-regulated banking system that they're also being protected.
Yeah, I agree with all that. And I would add, though, that with the fintech industry or banking as a service as a model now becoming more and more popular, it's vital that our member institutions, large regionals or national banks, have the ability to innovate, aren't confined by the rules that are being written solely for them right, without having equal playing, or level playing field for those fintech companies and for innovators in that space. I mean, we're all for the innovation on either side, but we have to be able to have the flexibility to do that as well. And I'll add too, though, this is another reason the CFPB is very important, because they have a supervisory authority over the non-banks, and that is going to be vitally important going into the next few years, where we're having I think a larger uptick in banking as a service and fintechs entering that space and partnerships.
Sure. There's a great story from the early days of Upstart where it was founded by ex-Google executives primarily and people who had not worked in banking, and in their exuberance to be part of the industry and to be friendly to regulators and to get in front of them, showed up at the OCC Office of Information in San Francisco and said, "Hey, we want to tell you about what we're doing." Very excited, which was maybe the first time that had happened at an OCC office. And so we do work very closely with the regulators, like why we don't get examined, our clients do. And so we spend a lot of time with the OCC and helping them understand, and the FDIC and helping them understand how we use AI and how we think about AI and how we work with our bank partners. I think, is that a space that you're particularly seeing probably more uncertainty and maybe less of an even playing field, where the banks may be getting challenged harder on use of AI versus fintechs and banking as a service providers can move a little bit faster?
Well, they definitely can move faster. I mean, there's no doubt about it. Banks have to be very measured in their approach to any new technology, especially AI. I mean, it's highly scrutinized, right? I mean, it's a little scary. I mean, to be honest with you, right? And we do need good regulation and sound law around the use of AI, or it could run amok, right? And so, but you have the fintechs that are able to move a little faster, and that's not bad for the banking industry as a whole. As long as we can partner and work with these organizations, there's also third-party risk management issues that are abundantly, our banks are abundantly supervised and examined for, and we encourage that innovation, but we have to be able to implement and partner or build that to be able to do that ourselves as well. In order to make sure that we're able to do that, we need to be very, very measured in our approach to regulation that only affects us, the banking industry and depository industries, federally insured, FDIC deposit industry. So, but the fintech industry plays a very important role in getting us to the next level, and so not saying that they shouldn't be able to do that. We just need to have guardrails. Absolutely.
Yeah. And I think fair lending particularly is an area that comes up frequently, that traditional underwriting models, logistic regression, whatever your, even table-driven models, or is easier to explain, or at least it's already documented with the regulators. How do you examine a bank that is using a model like this? How do you examine a bank that is partnering with a fintech that uses AI in their underwriting? Much less clear, and kind of gets back to your certainty. Like the rules of the road aren't as clear. I think there's certainly a challenge with individual examiners not necessarily having the know-how to do it, and I think there's an education challenge there that we're trying to help.
This is a challenge in the current environment now too. I mean, you're seeing a lot of the regulators leave the agencies. A lot of the folks that were embedded within some of these financial institutions knew them, had a historical context of the institution, and now we're seeing fewer and fewer team staff at the regulatory agencies. The examiners are half of what they used to be. They have to be brought up to speed, and so it's important to have a really well-educated, very informed regulatory exam staff in order to make sure that banks and fintechs can get to these places, and that they're not being halted on something that's misunderstood just because the regulator might not understand the process and or the institution that's implementing it.
Absolutely. So how do you, as you think about your member banks, how do you advise kind of the business teams, the lending teams, the heads of innovation, the different functional areas to work closely with their kind of legal and public affairs team to navigate what's happening right now in the market?
We provide no advice to anyone. No, I mean, quite clearly. I mean, we try to shape the policy that best suits our industry, right? And we work very closely with the policy folks within our member institutions, the legal teams. As a lawyer, I can say the lawyers probably, hold up most of these things for very when they shouldn't be. But that's what lawyers do, and that's what we pay them to be careful. But obviously, it takes a village, to kind of push, an organization forward. And I think that, working closely with the policy, especially the folks in DC, and now more importantly, the state, policy folks, and the legal teams, is vital to the survival of some of these institutions.
And just to add to that, I think over the last 4 years, as difficult as some of the rules and regulations coming out of the prior administration were for the industry, for especially the largest institutions, when the business lines really got a sense of the financial impact that one specific regulation among many would have on their ability to provide that product and innovate on that product at the level that their consumers expect, I think really heightened the pressure that corporate executives across the industry put on DC. And so you saw that obviously government affairs and traditional lobbying was always a priority, but that really expanded to the public affairs ecosystem. And so you saw really historic levels of investment with digital advertising, grassroots coalitions, grass tops, which really means more paid stakeholder engagement. So identifying those small business owners or some of those think tanks that can speak on behalf of the industry, that really all revved up over the last 4 years. And I think there's a perception that in many cases it was at least somewhat successful. And so I think that kind of atmosphere of the intersection between the business priorities outside of Washington and the teams on the ground in terms of public affairs and government relations will continue, regardless of who's in the White House.
Great. Yeah, and I think we've certainly seen it on the fintech side of the world too, that American Fintech Council, which we're a founding member of, used to be the Marketplace Lenders Association. We're actively engaged there. I know we've got a lot of some similar organizations that are doing similar work and partnering up on various initiatives. So I think it's definitely been a very, very active few years and doesn't look like things are slowing down at all. So kind of last thoughts or last question for the both of you. Any kind of bold predictions, emerging issues, things that might surprise us for the year ahead that banks should be really preparing for, could both political and regulatory standpoint. Like, is there, with the uncertainty, what could they prepare for to be ready for 2025?
You want to start, Dave?
Sure.
That's a big question.
You're going to take the easy one.
I'll take the easy route. Well, obviously, banks need to be able to, our member institutions need to be able to pivot quickly. And I think us providing them with a little bit of kind of signals of where things are going with some of the rulemakings and other things will be helpful for them. But it's just kind of a new era. We're very dedicated to stopping that pendulum swing between administrations. I think that we're going to see a pretty big pendulum swing for the next 2 years at least, because they have majorities in Congress, and that might change in 2 years. And so they're going to have a pretty healthy agenda going forward. So it will be an interesting couple of years. I think banks will enjoy some deregulation and some wind down of some of these more egregious rules that were quite honestly outside the authority of the regulators to even promulgate. But we're going to have to be very nimble, right? And be flexible about our approach to how we're working with our regulators. But I think we also need to advocate for what we need the regulators for. And that is to make sure that the system is working, that we have level playing fields, and that, quite honestly, that we're proud of being the most regulated or heavily regulated, heavily supervised industry because, we're there for the American public. It needs to be well regulated, well supervised. And so hopefully we'll get back to some of that. Yeah,
just to add to what Dave said, I think a lot of institutions right now in the financial services space are, especially for reputational risks, trying to stay a little bit more in the background, which is obviously an intentional choice. We'll see if they're able to continue to do that, and a lot of that depends on the political environment. From a policy perspective, I think banks and credit unions and fintechs need to be prepared for what seems to be more likely instance of legal framework being put around crypto and stablecoins. It appears there's bipartisan consensus in the House and Senate to advance that. And obviously you saw in the president's campaign, huge coalition of crypto and stablecoin influencers and leaders, and that seems to be something that is going to make progress in the months to come.
Awesome. Well, thank you. Thanks, Dave. Thanks,
Thank you.
Billy. Appreciate you being on the
Thanks for
podcast
having us.
today.
Yeah,
Thanks for
appreciate
joining
it.
us.